Good morning, everybody. I'm so happy to be here today from Rye, New York, once again. So Danny Jarrett here, founder and CEO of DC Finance's Family Office and High Net Worth Community. And as usual, we'll buy some time until folks will get on the call. I'm here today with Richard Beleutz. Good morning. And where are you in the world?
Good morning. I'm in Chicago, Illinois, so the heart of the Midwest here.
Yeah, Chicago is actually an interesting market for us. We're basically this year, we were supposed to do our first Chicago-based conference with great partners, by the way, such as the Jewish Federation and Target 21 and John Messervy, a known consultant for ultra high net worth in Chicago. And he's based, by the way, he will be moderating the conference we're doing next month. September 24th, we are doing basically our first conference after the after COVID started. So we're doing it at the rooftop of the World Trade Center, courtesy of the Silverstein family. So we are very excited about that. We have an exciting speakers there. So he will be moderating that. Today we'll talk about a world that I don't think many people know, an uncorrelated investment vehicle of life settlements. And I believe we'll talk about the entire field. I think, you know, some people that are not aware enough how this world looks like might think of it as a morbid and problematic space. I know the space from years before. That's not really the case, and I think that's one of the things you will talk about today, and the implications of COVID on that. I think maybe we'll start by saying good morning, Richard, and I hope things are well in Chicago today. And I guess we'll start with your, Richard is the CEO of Air Asset Management. And maybe, Richard, you can start by, you know, telling us a little bit about yourself and how you ended up here.
So thank you, Denny. So I've been a life settlement professional since 2006. My first experience in life settlements, I launched a hedge fund in the life settlement space. We had a brokerage company, and I was a partner in a life expectancy company. You know, we launched those companies in 2007. So I've you know, really enjoyed, you know, the arbitrage of the pricing of life insurance. That's really one of the underlying underpinnings of the space is the arbitrage in the pricing versus the life expectancy. And, you know, for me, my background is 27 years in financial services. You know, life settlements was my second financial product arbitrage. My first financial product arbitrage was with international mutual funds. There's also a mispricing in that space, and so we had a trade that we did in the late 90s and early 2000s. So when I became more acquainted with life settlements, it was a natural fit because of the asymmetric risk return profile. In you know, our businesses, you know, our hedge fund that we had a premium finance leverage facility attached to it in 2008 when Lehman Brothers went under. The bank, or Belgian bank, pulled our credit facility for premium finance, and so we had to liquidate our portfolio. Our investors actually produced a positive return, and we liquidated it by February of 2009. So we produced a positive return for them. And our initial life settlement array of businesses hadn't reached a scaling point to make it through the aftermath of the credit crisis. Our life expectancy company was really geared up for securitizations, which haven't come back. The hedge fund was really a life settlement trading fund that was really just designed to trade hedge funds. That trade has come back. Hence, I'm here today. In 2014, I was approached by a longtime friend and business partner of mine, Jose Garcia from Carlisle Management, and he was interested in coming into the U.S. And needed a partner. And since we had a pre-existing business relationship and personal friendship, it made sense. And I saw that the timing was good to come back into the space. And so I formed Air Asset Management and basically launched our first product.
What do you do there? You're basically getting in the life settlement world, but if you can explain a little bit what you guys are doing.
So we have a platform of financial products that are focused on and geared in the longevity space with a primary emphasis on life settlements. We're over 300 million in assets under management currently. We've had extremely strong growth. We have an outstanding team, and we have products that look at other components of longevity outside of life settlements. We're doing annuities and structured settlements, and we also are focused on the longevity private credit space. We're lending against assets, longevity assets at solid risk-adjusted returns as well. So that's the overall. I'm going to share my screen here so we have some slides so we can have some visual. Let me that in place. Here's a quick snapshot of the existing team, Air Asset Management, and then what is longevity investment, life settlements, annuity structured settlements, and life insurance, and other longevity-based lending.
And can you share with us the what is it really when you talk about longevity investing? And while you're there, if you can also talk about life settlements. I mean, I think we all know in general, not all of us, I mean, some of us understand that life settlements has to do with people's settlements that they don't need, or, and I understand that the insurance companies will take it unless they will keep on paying the payments, and sometimes it doesn't make sense. So if you can start by telling us more about the longevity investing and what really is life settlement.
So longevity investing is investing in assets that have a financial or economic return component that's associated with a human lifespan or an array of human lifespans. Life insurance is the classic example of that. Obviously, there's folks are familiar with life insurance where there's a financial payment at a mortality event or a death. That's and if you're buying a life settlement, that's what it is. It's a purchase or sale of a life insurance policy in the secondary market, typically from people who don't want or don't need them. With life settlements, your short mortality. By short mortality, I mean that there's a financial windfall when there's a mortality event. There's other types of longevity-based investing. There's mortality neutral, which is the private credit or life insurance-backed lending component. And then there's the short mortality-based investing, which is the annuities and structured settlement market. And so in the annuities and structured settlement market, basically you're buying income streams from folks that don't want or don't need them, and those income streams are backed by life insurance companies and annuity companies, basically. And you have a guarantee of a payment for a certain period of time. Typically, it's tied to the rest of their life. Sometimes there's forward starts, etc. And all of that is longevity-based investing. What are life settlements? That's the largest component of longevity-based investing for our organization. And I touched upon it, but basically, it's we typically focus on the senior life settlement market. And a senior might have a policy, and seniors are 65 and over for this definition. Typically, it's folks in their 70s and 80s that have old life insurance policies that they no longer want or need. And there's a very robust secondary market for that. Lots of institutional players and boutique and niche independent players in the space that will buy those policies. There's marketing organizations that do advertising on television. There's broker networks that will call on the financial advisors and accountants and estate planning attorneys and financial professionals, insurance agents to help educate them that life settlements are an option for folks that have these policies that they would ordinarily simply lapse.
Why wouldn't they really need it or want it? I mean, I understand when I relocate from one country to another, I may want to close the one I have there and open one here. Why usually people don't need it suddenly or don't want it anymore?
So in the senior life settlement marketplace, I'll just don't need, and then I'll cover don't want. The don't need means that, perhaps you have to look at why they took the insurance policy out in the first place. So they may have taken the life insurance policy out because they owned a business and it was attached to a business buy sell, and they subsequently sold the business. So there's really not a need for that. It could be because of originally taken out because of estate planning needs, and because estate planning rules have changed, again, no longer need. Could be because of income replacement and taking care of kids or college education or other types of needs, and their kids are grown up and now financially independent. So those are just some examples of the no longer need. Maybe there's a spouse and the spouse passed away before that individual. Stuff like that. So that's the no longer need. No longer want could be they just simply can't afford the premiums. Maybe they need to increase cash flow and by eliminating expenses in retirement. Could be they can afford to pay the premiums, but they just simply don't want to. They're tired of paying the premiums. As folks get older, the premiums tend to go up, right? The cost of insurance certainly goes up. So that's another reason. Perhaps they just simply want access to the cash value without having to support the policy with the premium payments. So those are common examples of no longer want the policy.
And why is it deemed socially responsible, really?
So London School of Economics did a study on life settlements, and one of the key findings is they found that it's truly a win-win for both the consumers and the investors. The reason it's a win for the consumers, which is the reason why it's now considered a socially responsible investment, is because it addresses one of the largest SRI issues, one of the hot button issues out there, which is senior financial independence. Many seniors out there are behind for their retirement, behind on the retirement savings, yet have life insurance. A life settlement, can provide up to 7 times the cash value on average, according to studies, in terms of the payment that are given to the seniors. That's found money. Oftentimes, seniors don't have many financial avenues. They're not working. They have a limited set of assets, fixed income. So, being able to sell a policy that was once a liability and turn it into a significant asset is something that is a strong SRI component. And it's kind of interesting because the way that when we first entered the space, we understood what good it did from seniors just anecdotally, just through testimonials and just being in the industry, just the gratitude that seniors have when they can monetize this asset and find this capital. But we didn't really consider it a socially responsible investment until we were approached by the socially responsible investment community wanting to come in and support the space. And we have many socially responsible investors that have come to us. We've created a white paper on the topic. If folks are interested, they can get in touch with you or me, and we're happy to disseminate them a copy of that. We're also part of a lobbying effort in Washington to put through kind of a healthcare savings type bill, which has bipartisan support. Now you need to attach it to something, right? But we've been working on that to basically make the proceeds of a life settlement non-taxable if they're utilized for healthcare long-term care. And that's received some, pretty strong bipartisan support. In 8 states, the state insurance commissions are requiring notification, some form of notification to seniors when life settlement policies are lapsing, that life settlements is an option, because the regulators see that there's a distinct benefit to life settlements being evaluated prior to the lapse of a policy. It's estimated that less than 25% of seniors are even aware that life settlements is an option, and roughly 90% of policies lapse and don't pay out a death benefit. For these reasons, life settlements have been considered socially responsible. To further that, we're a signatory to the Principles for Responsible Investment. We as an organization believe in socially responsible investing, and so we hold that in stewardship in terms of the operations of our organization and also in how we approach the longevity investing that we do. And for those that aren't familiar, PRI is an organization that's global, that takes in the factors of ESG that were created by the UN and certifies them across investment and corporate organizations globally.
And using these tools, you can measure, how much you can actually measure it.
You can, and so there's, the most kind of obvious component of socially responsible investing in the life settlement space is in the small face secondary market. But obviously, if you're buying policies in the tertiary market and you're providing liquidity for the providers, the marketers, and the originators in the secondary market, there's a value downstream as well. So that's that's kind of the socially responsible angle for for the life settlement space. And it's funny because it's a lot of people are a little uncomfortable when they first hear about this asset class because they think about it as profiting from death. They think about it, some people are have a funny feeling when they think about life insurance. Some people don't like to think about mortality. Some people just don't like to, go there, and that's okay. Life settlements investing is not for everybody, but I think when you really start to dig in the space, and as our investors have, and you really look at the social good that it does for the seniors, the LISA, the Life Insurance Settlement Association, has testimonials. If you talk to the life settlement brokers that deal with the insureds, they'll tell you, if you talk to the direct to consumer programs, they'll tell you that it does change lives.
And I think that and I'm not saying that because you are one of my guests and supporters. I'm saying that as an ex-financial journalist before I started, the family office community. And I remember when 5, 6, 7 years ago, or even more, when we wrote about this space, some people were mentioning, oh, this is not something we look at, it's morbid. How can you profit from death? And that's exactly the opposite when we're looking at what you're talking about the ESG factors and the fact that actually socially responsible entities are asking you to come in. Because I think what people don't understand or don't think about enough is that, I think, correct me if I'm wrong, as an insurance company, that's beautiful. They would say, oh, you don't want to pay anymore? Where do we sign? Great. All the money we made so far is ours. We have no risk. We're not going to pay you nothing. Don't worry about it. Don't pay anymore. We want more customers like you. And then what happens is the big, huge insurance companies are becoming wealthier. And the poor people that actually paid them for ages and for whatever reason cannot or don't want to, they're left with nothing. But I think it's a dream come true of every insurance firm.
Yeah, as I mentioned, 90% of life insurance policies lapse either due to replacement or due to just people no longer wanting the policy or needing the policy. And so all those premiums obviously go into the coffers of the life insurance companies. Now, the U.S., and we'll get into some of the size of the market, but the U.S. life insurance industry is over 20 trillion. That's more than the rest of the planet combined. The life settlement market is over 100 billion. So it's an extremely small part of the overall insurance industry. So it doesn't necessarily hurt the insurance companies, although obviously, a dollar profit, for a death benefit that an insurance company has to pay, is a dollar that they don't get to keep. So you're right, the insurance companies would prefer that somebody buys a life insurance policy in the 30s, 40s, and 50s, and they lapse it in their 70s or 80s. That's perfect. They pay premiums for a very long period of time. And then right at the point where the mortality curve starts to increase in terms of the probability of needing it, then the policy goes away. That's a great deal for the insurance companies. And so that's why the life settlement industry is not necessarily a win for the insurance companies, although it keeps their lapse rates down. They do collect the premiums, and it's not all bad for them. But it's certainly a win for the consumer. They can settle their policy, and it's certainly a win for an investor that can buy a non-correlated asset at with high-rated insurance credit attached to it at a double-digit IRR.
By the way, one family here is asking if they can get a copy of this presentation after the webinar. I'm not sure.
Yeah, I'll have my contact information, and if anybody just wants to, on the last slide, and if anybody just wants to email me with that request, I'm happy to send it over.
So we started to talk about the size of the market. If there's anything else you can mention there, please do. And I guess my next question is, how do you find these policies? How do you find the people that actually need it?
So get into policy sourcing. I touched on policy sourcing, and basically there's three markets. There's the primary market for life insurance, and that is when the insurance agent sells the policy to an insured for the first time. The secondary market in life settlements is when that individual, in our example here, the senior life settlement market, settles that policy for the initial time. And that's sourced one of two ways typically. It's either sourced through what's called the direct-to-consumer marketplace. The direct-to-consumer marketplace is the ads you see on TV, print, computer, media, radio, etc. That and where they have you call an 800 line, and then they'll give you a quote direct on your policy. Those tend to be smaller policies, kind of 100,000 to $1 million. And then there's the broker market, which I mentioned. Currently, I think the broker market is 75–80% of the overall market, although the direct-to-consumer is growing. The broker market tends to, they're licensed life settlement brokers that are required in most states to have licenses, and they're the ones that act as the fiduciary for the insured that are looking to settle the policy. So they'll call on these accountants, attorneys, etc. They'll get referrals from their clientele, and then they'll take that financial package, which includes copy of the illustration, life expectancy reports, etc., and then they'll shop them out to the providers. The providers are the licensed buyers that represent the asset managers like ourselves. And so it's a broker market, transacts much like real estate. And then there's what's called the tertiary market. And that's the investor to investor market. So let's say an investor like us decides to buy a policy through the secondary market. We can buy policies, typically when you buy them one at a time, you get a little better price because it's a lot of work to put together the initial package, kind of like mortgage-backed securities. But once you aggregate them, you can sell them in portfolios in the tertiary market, and there's a little bit of a spread play there. And so you can trade them in blocks, and it's efficient and it's quicker and it's cheaper to do that. But that's what's called the tertiary market, and that also provides liquidity for both open and closed-ended funds that have limited lifespans or liquidity needs.
Now, how do you generate returns, and how do you measure your risk when you're dealing with these policies?
So returns are really generated through the IRR at purchase in open-ended fund with some type of mark-to-market component, and we can get in what the best practices in the industry are for that. But and they contain both unrealized returns in terms of your accounting gains, which is basically your NAV, or accounting losses, depending on how well you buy and where your NAV is set at through the market rates. And then there's realized returns that are generated from trading. Those are typically capital gains, which are more tax efficient. And then there's maturity income. The maturity income is obviously when a death benefit comes in, and those are typically taxed at ordinary income. So the market, depending on who you ask, there's a lot of different ways to measure the average market rate, but it's anywhere from, call it 10.5 to 14.5% is kind of the range of market rates, depending on what type of policies you're trading in buying. So I use an example here of 12.5%. So let's say if you buy a policy at 12.5%, the question is, or you have a portfolio of policies, right? And that's usually the best way to realize that IRR. But I'll use this example in terms of one policy. What's the biggest risk, and how are you compensated for that risk is the question I often get from prospective investors and existing investors. So the biggest risk in life settlements, period, is mortality or longevity risk. It's just, you don't know when there's going to be a mortality event in any given individual. You can do all the analytics that you want, but there's a lot of variability in lifespan. And so that uncertainty and that risk, you're getting compensated for roughly 5% in a life settlement portfolio or for a life settlement policy. The second biggest bucket is all the esoteric risks. It's the risk that the policy was sourced correctly. It's the industry and regulatory risk. It's just all the esoteric risks of the asset class are about 3.5%. Take a look at the liquidity risk. These are level 3 assets that are traded over the counter. So you need to have trusted counterparties to be able to transact. That liquidity risk is measured at about 2%. And then you got, the credit risk, depending on what the average credit rating of credit rating of the individual policy is, or the average credit rating of the portfolio. You got to spread to the risk-free there. And then I think I have a several-month-old example here in terms of what the risk-free rate is. But that gives you an assessment of kind of why you can buy a policy at double-digit returns when you have low credit risk. There's other types of risks. Now, as portfolio managers, one of the things that we're adept at, and one of the things that we can do, especially if you're working with experienced life settlement professionals, is you can diversify a lot of these risks and you can mitigate a lot of these risks. The most obvious example is mortality risk. A couple of things that we do on the mortality risk side. One is through the law of large numbers and building larger portfolios, you get a more normalized, revenue stream. That's the first. The second thing is by buying healthy insureds, which is a little counterintuitive because they have a longer duration or a longer prospective lifespan. But by buying healthy insureds, you tend to have less volatility in mortality, because by nature they're already healthy, and the mortality data that we have is based on the overall population, which is fairly healthy. And so you have more predictability from an actuarial standpoint versus what a lot of our competitors do is they'll try to do what's called an impairment arbitrage, where they'll take a look at fundamental factors of health within a specific insured and try to predict early mortality based on an array of factors and their medical analysis of that. That, in our view, that injects a lot of bias into the transaction because every individual is unique, and even if you try to get a combination of impairments, you'd have to have an enormous number of those to actually be able to have predictability in that. So there are good ways to mitigate mortality risk depending on what your strategy is. And what that allows you to do is that allows you to harvest what I call the life settlement beta, or which is really the market rate from the transaction. If you take a look at the return streams of our competitors, they're not even able to return the market rate. And the reason is because of the fact that they inject, in our view, risk factors into that mortality risk by trying to pick the stock that's going to beat the S&P 500. What we do is we like to just buy super cheap, diversify. We like to trade. One of the reasons that trading we believe is a good strategy is then you have a realized return and you just mitigated the biggest risk in life settlements, which is the mortality risk, and you did it in a tax efficient manner with capital gains versus ordinary income. So that's an example of how we view the risk return profile in life settlements.
Yeah, and I see here several questions. We'll get to it in a second. I have a couple of more questions to ask, including COVID-19. But before that, we wanted to ask where you position them in your portfolio. And maybe I want to add two more questions. What is, so how does one invest with you? What's the minimum investment? And with your different financial vehicles, can one choose to be in a riskier, at a riskier layer of this space, or it's basically everything put together here? How do you, work that part?
Because this is a public webinar, basically, conversation, I can't get into product specifics, but for those that are qualified clients, which is 2.1 million net worth, or qualified purchasers, which is 5 million liquid net worth, And if they want to email me, I can, begin a dialogue with product specifics. But in terms of your question, in terms of products, do we have products that have different risk profiles? We do, but it's much different than one might think in the equity world. There's only so much risk you can take in this space due to the nature of it, and so it's really not a risk play for us. It's more of a portfolio diversification play. So it's not huge variance, but there are differences in some of the different strategies we have to the risk profile, but it's subtle.
So we have lots of questions coming here. I wanted to ask you where you position them in your portfolio, but I also want to get into what I think everybody would like to hear about COVID-19. How did that, if you can also address that after my first question, influence the market? I'm very excited to hear how that affected the life supplement market.
So first I'll address where do you put this in your portfolio, right? And then I'll get into how has life settlements, been impacted, both the industry and the cohort, with COVID-19. So the most common place that folks consider this in the portfolio is within the private credit spectrum. And it sits in the specialty finance arena of private credit. And the reason is simple. You're buying a contract from a rated insurance carrier, which is a promise of payment if a certain condition is met. And so when you really break down to it, private credit is an obvious. Some folks put it into market, esoteric market neutral, niche, they'll put it through, obviously it's super uncorrelated. Alternative fixed income is also a popular place to put it, although it's not a true fixed income investment. Depending on the structure, some structures have distributions, some don't. The ones that don't tend to be the more liquid structures, which you can create some type of systematic redemption and kind of synthetically have an income component to it. So that's also a commonplace position in the portfolio. Getting into the time relevant question of, so how has this global pandemic thing affected this industry? The first kind of impact to the industry back in March, April, when there was heavy social distancing, was a slight reduction in activity in the secondary market because wealthy seniors, because of the uncertainty of their own mortality, A, didn't want to settle policies. B, they weren't meeting with their financial advisors. There was no urgency for them to liquidate the portfolio. So we saw a reduction in secondary market activity through the broker channels. In the direct-to-consumer channels through the secondary market, there was a little bit of an uptick you saw in some of the big advertisers and some of the volumes as folks kind of scrambled for liquidity and not wanting to pay premiums, et cetera. And those tended to be in the smaller policies. Tertiary market remained active as needed. Probably a reduction from what we've seen in the opportunistic buying and selling. But a spike in programmatic selling due to some redemption activity from folks that needed liquidity. And then, robust, continued programmatic buying from the institutions and closed-end private equity funds that had capital to deploy. No major interruptions there. in the secondary market, the broker market, we've seen a bit of a resurgence. Now there's a seasonal effect where it tends to be a little slow in the summer, but we're anticipating that to continue as there's mobile escrow agents and a lot of technology in place to be able to settle policies, socially distanced, and folks are getting accustomed to, the new normal, as they call it. So that's really the industry. So, industry conferences are virtual now, and we're doing lots of, webcasts and webinars and virtual forums to connect with investors. So because of technology, for us and for this industry, not a significant or major disruption. In terms of the COVID-19 impacts on the life settlement population, obviously the senior life settlement market is the cohort that has been the most disproportionately affected, by the coronavirus. And so, that's a fact. In terms of, what we've seen in the marketplace, it hasn't been a significant impact. Mortality overall has gone down this year because of social distancing. You've had a reduction in auto accidents, a reduction in cancer, a reduction in deaths, and a reduction in stroke deaths, a reduction in heart attack deaths. You've had an increase in kind of the COVID-19 deaths because there was very few last year. So that was an increase, but overall mortality has gone down. And you also have the wealth effect and the distress effect. The wealth effect is, the wealthy folks, which a lot of the senior life settlements, especially in the $1 million policy range and above, which is the majority of the market still, it tends to be isolated from a lot of these issues, and they get different level of medical care, et cetera. And then you have the effect of the distress effect, where seniors tend to have lower mortality in times of stress, global stress. If you look at wars, or if you look at deep recessions and depressions, historically, they've had less mortality during those times, and the rationale is they're needed. Their wisdom, their experience, their resources are needed. Now, there's a whipsaw effect to that. And the whipsaw effect is once that stress goes away, that bears its toll on an aging soul. So, I don't have a crystal ball with any more clarity than anyone else on this planet, but, so far, we have not seen, a really significant impact due to the corona. Maybe a little anecdotally a little smaller increase in mortalities in the smaller policy range, maybe a little decrease in mortality in the bigger policy range, and a big question mark on what's going to happen when winter hits and people aren't getting as much vitamin D, not getting as much exercise, and we have another wave with so there's question marks there. But that's kind of how we've understood and how we've viewed COVID-19 on our population.
Wow, fascinating. Now, before we'll jump to some questions here, how does one get in touch with you? I mean, we will send you information as well at a follow-up email tomorrow, but what's the best way?
So here's our contact information. If you want to email me direct, my name is Richard Beleutz, and it's RBELEUTZ. So my first initial, my first name, and my last name. I can also be found on my website, and then the URL at airassetmanagement.com, or you can send it to info. I'm copied on that as well. Just mention that you want to copy the presentation, or you're interested in looking at our investment materials, et cetera. And we'll need to certify your accreditation and all that kind of stuff. So that's how you get a hold of us.
Thank you for now. And we'll go to some questions that we have. Maybe Richard, when you can stop sharing the screen so people will see you better. And by the way, whenever I see Chicago, you know, our event this year in the States was supposed to happen in Chicago, a new destination of ours. And one of our greatest speakers comes from Chicago, Sam Zell. So where do I start? Okay, are there any emerging trends on the horizon that you believe will impact this investment space?
So one of the trends is, I mean, I see two major trends in this investment space. Both of them, I think, are real positive for it. One is the amount of investor interest in life settlements is grown exponentially as this is being more accepted as a mainstream type of investment across the investment community. Kind of the ick factor of the space is really shaken off with the social responsible element that's really been highlighted. And so investment dollars are flowing. That's A. B is you have the baby boomers that are coming into you know, the right age for a life settlement and all the policies that they have. So you're seeing a massive spike in supply in addition to continued awareness. Back when I managed my first life settlement hedge fund in 2008, roughly 10% of the market was aware that life settlements were an option. Now it's up to 25%. Soon, because of the communication age, it's going to get higher. Maybe in the next 10 years, it'll be 50% or higher. So as people become aware that this is an option, you know, you're gonna see more policy flow. So you see more investment dollars. You'll see more policies, and that's why actively managed life settlement strategies like ours that have a market making or a trading component of it, where we build portfolios, warehouse, flip for spreads. We do that on the structured settlement and annuity side. Those types of strategies will have more and more relevance and opportunity.
And can an individual just go and buy a life policy on his own without bothering with the asset managers, brokers, etc.?
An individual can buy a policy on their own if they go through a provider. Many providers I know won't sell a policy to an individual. They just, you know, I mean, there's certain responsibilities. Obviously, there's certain regulations, and you know, from an investment standpoint, you know, it's not a good investment for somebody to buy one policy. There's just too much variability in it, typically, and there's such nuance in the space. There's over 700 life insurance carriers in the space. Each life insurance carrier has dozens of different policy contracts. Every policy contract has its own unique attributes. In order to harvest the return, you have to do things like premium optimize. The only way you can really know how to premium optimize is if you do test lapsing and you have a database of all these types of policy contracts. That, you know, there's a lot of nuance in just managing the asset class that really can only be yielded through experience and through time, and that's why it's you know, it's tricky for folks to do that. And in the early wave, and kind of when I was first in the space, you saw a lot of folks doing that, investment clubs buying 10 or 15 policies, etc. Not many of those turned out very well, and that's the problem with new asset managers coming into space with, you know, a bunch of bright minds coming in with dollars without the proper you know, experience, advisors and counterparties and guidance. You know, we still see life settlement companies that have grown too fast and have gotten in trouble. That you know, so it's you know, not easy. It requires experience, so not recommended, but possible.
Is there a non-recoverable withholding tax on maturity, and if so, how high is it?
So for the U.S. and in countries with the appropriate tax treaties within the U.S., there's no withholding tax. There is a 30% withholding tax if you're in a non-treaty country, and you know, we have share classes that manage that, and our administrator manages that. But you know, it depends what the domicile is.
Do you operate life settlements businesses in foreign markets? like Dubai, India, Mexico?
We do not. So there are life settlement markets in other countries, but the vast majority of life settlements is in the US, and that's done for a number of reasons. One is it's regulated in some fashion in 46 states. You have a Supreme Court ruling, 1911 Grisby versus Russell, that makes life settlements possible because makes life insurance a property that can be bought and sold. You have tax opinions, you have a lot of legal precedent and case law, but most importantly, you have product structures that allow for this. In the US, you have something called universal life, which is the vast majority of life settlements. And universal life, you can do with that premium optimization where you pay just the minimum amount of premium for the ability to get the full death benefit. And that really gives you the ability to optimize your return. In a lot of foreign countries, you have what are called endowment policies. Some countries, life settlements are illegal. If you have an endowment policy, the returns are very low. So this is primarily, certainly institutionally, but it's primarily just a U.S. market from an institutional standpoint.
Now, I think you've addressed that a little bit. One of our families from Asia is asking how would this type of investment impact non-U.S. investors, in particular Chinese investors?
So we do have structures for that. We have one specific structure that works well for, and it's with a Chinese partner that works well for Chinese investors that have offshore assets. So we have structures in place for that.
After the senior sells the policy, how is their lifespan tracked? Are they still tied to the policy in some form or fashion?
So there's a HIPAA release form that they sign as a part of their initial closing package when they settle the policy. And that HIPAA release form allows the owner of the policy to look at their medical records, prescriptions, et cetera, for the rest of their life, basically. So we have the ability to get those medical records at any time. There are services, there are tracking services. Social Security database is a common place that is probably the most efficient place to determine mortality, obituary tracking services, et cetera. There's a whole industry around it, and it's not just for life settlements.
What about the non-resource premium finance policies that were a hot item back in 2008?
So it's one of the things that we diligence for is STOLI. So we're not going to buy a policy that it's STOLI or it doesn't have or has the wrong type of premium finance on it. That's pretty easily discernible. So there's enough out there you buy the good stuff and throw away the junk.
I remember years ago, agencies providing the analysis of mortality to determine the ROI were faulted. What new provisions are now in place for proper rating and accurate ROI?
So on the actuarial side, the issue wasn't with the Society of Actuaries. So the VBT tables, valuation basic tables, basic valuation tables are basically produced every 8 to 10 years by the Society of Actuaries once they've deemed that there's been a big enough change in overall mortality. This is a database of all the insured lives, and they break it down by year and sex, smoking, non-smoking, and they give mortality figures. These tables are what life insurance companies base their rates at, and these tables are what life settlement companies base their purchase and sale price and IRRs off of. And so there then comes in the life expectancy companies. Depending on how you count, there's 6 to 8 life expectancy companies out there that produce life expectancy reports, which are actual reports that basically give you a mortality multiplier and some other information on the insured to say whether they're healthier or more or less healthy than the average individual. Each one of these life expectancy companies also, not all of them, but some of them have their own proprietary, most of them have their own proprietary tables, their own proprietary actuarial tables that are derived through their own methodology. So when we're talking about tables adjusting, the Society of Actuarial tables, which are the ones we use, they're more conservative. A lot of the industry uses the more aggressive proprietary tables by the life expectancy companies. And what happens is the life expectancy companies update those black boxes and those tables with much less data points sporadically, randomly, and typically without notice. And so you saw a lot of our competitors take write-downs because they just simply put them on the wrong tables. They put them on the aggressive tables versus the conservative tables. So that issue really hasn't affected us because we use the mortality multipliers and that's basically, and put them on the BBT tables. And that's basically what our life expectancy company did back in 2008 is we had stable, so yield stable results. Can the life expectancy companies change the tables ongoing? Sure. Is it arbitrary and black box? It is. Are there reasons why some of the life expectancy companies keep their life expectancies aggressive from a buyer standpoint or seller standpoint? Yes, they sell more life expectancy companies, right? If they favor the investment advisor. Other reasons, why it makes sense to use the actuarial tables, the broader actuarial tables. We think so, and that's why those items haven't affected us or our partners.
Now, Ron, there's another, Ron, I see here, you ask a lot of questions. We don't have time for everything, so we'll leave that for you to speak to Richard later on, but maybe I'll just ask the first one. Can you discuss how the market has changed from a regulatory perspective since the days of HIV?
So back in the day, it was virtually an unregulated space. So you didn't have commission disclosure. It was the wild, wild west. You had legal precedents from 1911 in Grisby versus Russell. Dallas Buyers Club, it's a great movie with Matthew McConaughey, is the story about the beginning of the life settlements business as we know it today. And it was with the HIV/AIDS patients selling their life insurance policies to get drugs for experimental treatments that worked. In a lot of cases. So it actually did a great justice for those individuals that had HIV and AIDS because many of them lived and continue to live today. Many investors it didn't work out for because they bought insurance policies they thought were imminent death benefits but those folks lived. So and just like any new industry, there's crooks that came into the industry, there's cowboys that came in the industry. After the credit crisis, you saw a number of fraud issues of people that were, involved in the asset class. But since then, I call it the reinstitutionalization of the space. In 2007, 2008, you had, the vast majority of the tier one investment banks, Goldman, Bear Stearns, Credit Suisse, there's a ton of those type of named firms that had Deutsche Bank, Commerce Bank, that had life settlement desks or life settlement businesses that were substantial. A lot of those got out of it because of Dodd-Frank and the elimination of derivatives and a lot of their proprietary books. And so the folks that have come into the asset class sense, the BlackRocks and the Oak Trees and the Berkshires through Gen Re, one of their reinsurance subsidiaries, Apollo, are some of the big brand names that are in the space now that are private equity, more balance sheet type investors that are long-term, and it's much healthier for the space. So it's gotten reinstitutionalized since 2008. So more regulation, more rule of law, more experienced counterparties, more experienced asset managers. This is a relatively new space. People have learned from the mistakes, and you shun the bad actors. So you don't do business with them. You don't allow providers don't allow an individual to come in and buy one policy because that's not going to work out good for anyone, and it's just going to poison the well.
We're getting more questions, but we really are soon running out of time. Maybe what percentage are you allocating towards this asset class? I guess maybe the question is also from people's portfolios, how much they would, you would recommend to allocate.
I mean, we're an SEC registered investment advisor, but we advise our funds. So we don't advise individuals on how to asset allocate. But, obviously, investors, 100% of their assets in this class, they diversify it for liquidity. They diversify it, for growth. This is more I would put it in the, the kind of the private credit / fixed income component. Yes, it has a nice return potential. And yes, there's a lot of, things that we do to minimize the risk, but it's still an alternative investment class, and it's not exchange traded, and so you just want to make sure you have diversified. And I suggest speaking with your financial advisor on what's appropriate. We don't do that.
Great. So anything else, Richard, at this stage that you'd like to add?
No, I just want to thank, I see all the names in the audience. I recognize a few of them, some old colleagues and some other folks in the audience, and investors and prospects. And so, I just want to thank everybody for, tuning in to the webinar, and, just feel free to reach out with any additional questions or information.
Great. And I will say, first of all, thank you. And again, hoping that next year we will meet you in your hometown of Chicago. And I will just say that next week we have 2 sessions here on the 8th about antidepressant and anxiety drugs and what's going on there, which obviously has to do with COVID-19. And then on the 10th, one of the UK's top social activists, Miss Gina Miller. If anyone here is from the UK, I'm sure you know the name. So we will be speaking with her as well. And as I said, on the 24th, Tremel Crow, one of the most well-known families from Dallas, will be coming to our East Coast Family Office Conference at the World Trade Center. Tal Kerrett, president of Silverstein Properties, will speak there. David Sable, ex-chairman of Young & Rubicon, the world's largest advertising agency, and person with over 1 million followers on LinkedIn, will be there. And finally, Nadav Safrir, who was the ex-commander of 8200 unit, which is Israel's secret army unit of cyber and AI. We will even talk about the new peace agreement between the Emirates and Israel and what that means, not just for Israel, but for technology in general. So, Richard, thank you so much for your time. Thank you for being here. It's obviously a fascinating topic. And we hope to see you in person at some of our events, probably next year. And thank you, everybody. And we will send Richard's information as well later on.
Thanks, Danny. Thanks, everyone.
Thank you. And all of you stay safe. Thank you, Peter. Thank you, Kareem. Thank you, everybody. Take care.